Good evening everybody, thank you very much for joining in. This side Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP, and today we are going to speak about very interesting topic, which is central banks liquidity swap. I am also acting as a country director for two international forums which you will see, which is International Institute of Certified Forensic Investigation Professionals and country director for Association of Certified Forensic Professionals. Today we have taken up a very interesting topic, which is central bank liquidity swaps, because we all understand that nowadays what all is happening, the 100% credit goes to the central bank, because central banks across the globe are doing so much quantitative easing nowadays that they have just messed up. They just messed up the fixed income market as well as the foreign exchange market. You tell me one thing which they not messed up. They messed up everything. And if we go with the statements given up by the Kuroda, which is the central banker for Bank of Tokyo, he is saying that Tokyo is having further scope of quantitative easing, which is simply a bullshit statement, because you are doing the quantitative easing from the last 2 decades, and now you are saying that there is still a scope for quantitative easing, which simply means that you are just trying to kill the fixed income market of the country. Japanese along with the Europeans are the 2 continents where the interest rate is negative. The biggest bank of Europe, which is Royal Bank of Scotland, Bank of Ireland and Deutsche, they have already asked their clients to pay for negative collateral, and no such information has been reported from Tokyo whether the bank has been asked to pay negative collateral or not. But in a nutshell, things are moving in a negative direction and we have to be particularly conscious about that. In that regards, we would like to bring a very important topic for your consideration, which is central banks liquidity swaps. Now, this is how central banks liquidity swap is all about. Central banks liquidity swaps allow the central banks to provide foreign currency liquidity to the commercial banks and their jurisdictions since the end of 2013, right? Since the end of 2013, these swaps have entered as a de facto key feature of the international monetary system, with the US Federal Reserve having extensive recourse to doing the financial and their exploitation by the People Bank of China. Sitting today, People Bank of China is the only central bank across the globe who holds more than 25 cross-currency interest rate swaps or central bank liquidity swaps across the globe, which means that yuan is easily convertible into dollar, yuan is easily convertible into Swiss franc, yuan is easily convertible into GBP, yuan is easily convertible into Sing dollar, easily convertible into Canadian dollar and all. So yuan right now is a very easy currency to convert, and as we understand that effective 1st October 2017, yuan is joining the SDR league, and with this things would be very difficult for the people, for other central banks, because previously when yuan was doing the cross currency swap, it was a kind of basically the protection or the I would say the vision they were having to promote yuan as an international currency. But now when yuan is doing these kind of liquidity swaps, it clearly suggests that yuan wanted to take a very good position in the global financial system, which is shortly known as IMS, International Monetary System. And of course they have that as well. Today yuan is having a very good support from the international monetary system, and if I'm not incorrect, that by 2015, I think till 2015, more than 7 or 8% of the exports of the Chinese are happening in yuan, and CNH, which is acting as an offshore yuan, is also supporting China, because China is currently following what Japanese used to follow 22 years ago. They divided the Japanese yen into 2 parts, onshore Japanese yen and offshore Japanese yen. Similarly, Chinese divided their currency into 2 parts, onshore Chinese yuan, which is CNY, and offshore Chinese yuan, which is known as CNH. Of course, there is a spread between CNY and CNH, and there are a lot of traders who are trading on this spread, and we very well understand that the deposits in the Hong Kong are CNH deposits and not CNY deposits. But having CNH and having liquidity swaps of CNY is making lot of sense, So People Bank of China is a very key example when it comes to the liquidity swap. If I speak from a layman perspective, now what do you mean by liquidity swap? Liquidity swap is a kind of structure in which both two central banks join hand, wherein one central bank would like to offer a foreign currency to the another central bank at the time of the crisis, especially dollars. If I speak this liquidity swap from the Chinese point of view, I would like to suggest that the Chinese are not short of dollars. They are having more than $3.2 trillion of foreign exchange reserves across the globe. So they don't bother, about the dollars. In fact, as far as the reports are concerned, Chinese are also dumping the US treasuries, which is UST. And if this report is correct, then over the next few years, China would like to redeem major component of the United States treasuries and would like to take this money in their foreign exchange reserve and would like to spend this money, for basically spend this money on investments, or spend this money on some, like, for sovereign wealth fund or something like this, which is highly strategic for China. Now currency swaps are turning very important, and if I'm not wrong that in the last few weeks Bank of Japan, Bank of England also did a currency swap. But sitting today, Chinese yuan is the only currency who is having currency swap with almost all central banks across the globe, and henceforth the yuan can easily be convertible into any international currency. And of course, 1st October they are joining the SDR as well. Now moving further, in the financial system, swap are a derivative in which two counterparty exchange only the cash flows of both counterparty financial instruments against the instruments of other party. In the context of CBLS, Central Bank Liquidity Swap, foreign currency swap involve two currencies and therefore introduce the possibility to make the currency issued by one central bank advisable in the constitution of the other central bank, involving a swapping instrument like People Bank of China. Unlike the swap signed by Fed, the mandate of the swap agreement signed up by the Chinese central bank, People Bank of China, which amounts to, I think, 2.71 trillion RMB, which is local currency, or approximately $420 billion. So today, if China needs to convert yuan into dollars, then at least $420 billion can be easily convertible, provided you should have a raw yuan which you wanted to convert in dollar. And at the same time, I hope you saw our video and also followed us on the latest report given up by DBS Singapore, which suggests that with yuan incursion in SDR, more than $480 billion would be shared between 5 or 6 countries, and out of this China would get roughly 42% of the same, which is 10%, because Chinese figure is also approximately 10.3% in SDR. Unlike the swap signed by Federal Reserve, it is $420 billion. If I'm not wrong, Chinese are having more than 25 cross-currency interest rate swaps as of now. But as far as the latest number is concerned, I'm not sure, but 25 is something which they have, which I'm sure. So China have more than 25 international cross-currency swap with a different central bank, which also covers your Singapore, which is MAS, which is Monetary Authority of Singapore. Moving forward, now liquidity swap. Here we taken an example of China. Liquidity swap means liquidity swap are very important tools with central bank during a huge FX volatility. And you know that not a single day bygone when you don't see a news in the FX volatility. And I'm sure that the next week, which is on the way, would give you a lot of topic about volatility, because there are two important things which is going on. Number one, Bank of Japan would be coming up and taking a decision whether they would like to continue with the more QE or they would like to continue with the current QE, and so on. Secondly, Federal Reserve will come and say that whether he is interested in increasing the rate or not. All the market has already discounted the fact that the Federal Reserve is not interested in hiking the rate. I myself is sure that Federal Reserve is not in a position to hike an interest rate at least before December 2016. Now, if we go with an example, we are having liquidity swap. Liquidity swaps are very important tools with the central banks during a huge FX volatility. In case of huge FX volatility, central banks do such swaps, like Fed would share dollar with People Bank of China, and People Bank of China in return do the same like principal only swap. We already told you number of times that whenever the money comes in or goes out, then there is an interest rate component or there is not an interest rate component into a system. To hedge the interest rate component, you should do principal only swap. To hedge the non-interest component, which is the face value component, then you need to add the coupon only swap. But in both the cases, you are in a position to hedge this. And central banks, you all know, is having a lot of machinery in their hand. Lot of machinery, I meant to say, they have lot of banks. There are a lot of local banks who can help them in hedging that. Structure. Now, just 1 minute. Moving forward. Here we have taken an example of Chinese yuan. As far as the today's spot rate is concerned, I think it is approximately 6.68 types of the spot rate which we have between Chinese yuan and dollar, which means $1 is equal to 6.68 Chinese yuan. Yes, I would appreciate the fact that it has somehow depreciated versus the current level of some roughly 50-51. So that way. Now, assuming Chinese yuan is trading at 7.70, which is very high versus nominal spot rate of 6.60. In this sense, People Bank of China would need a huge amount of dollar to bring down the volatility. In this example, we are assuming that People Bank of China do not have the dollars. Sorry, Bank of China, yes, People Bank of China do not have the dollars. So they are left with only three options. Either they can use FX reserve, which they already used. Now, there was a time when FX reserve in the People Bank of China was 4.6 trillion and today it is roughly 3.2 trillion. Yes, majority of this money has been used to protect the spike in the national income, and this is good investment because considering the fact that this is good investment, right? So, because considering the fact that Chinese yuan is an NDF currency, so it is very much required to protect the valuation of Chinese yuan. Secondly, they can sell the USD. USD stands for United States Treasury Bills, not to mention again. Third, you can use the liquidity swaps with the central banks. And we all know that People Bank of China is having liquidity swap with almost all central banks. Liquidity swap with all central banks. So in that sense, it is not difficult for them. So what they do, they will do all three. They will sell the foreign exchange by 2 billion. They will sell the USD of 10 billion, and they can take the swap lines approximately $26 billion. And People Bank of China will sell this money in China. With this, they are able to protect the rate of dollar to yuan, because of course we all know sterilization. And as per the sterilization, if you wanted to depreciate the foreign currency, if you wanted to depreciate the foreign currency, then you need to sell the local currency in the market in dollar terms. And this is what International Monetary Fund did. They totally collected 2 billion from FX reserve, roughly 10 billion from USD, and approximately $26 billion from this line. So total they sold approximately $48 billion. Now the hedging of this swap lines, because after a certain period of time, people will come to People Bank of China and say, you took the dollars and I want my dollars back. So you cannot tell them, sir, I have given you dollars, but I have only renminbi which I can give to you. So can you please do this transaction, and so on and so forth. This makes no sense. So in this, what exactly would happen? You will try and cover your risk. And three options discussed number of time in the different videos on the same YouTube channel, People Bank of China. this is principal only swap, coupon only swap, and sum of both cross currency interest rate swap. Principal only swap is done to protect the FX volatility or the cash flow volatility of principal. Cash flow coupon only swap is done to convert the floating interest rate into the fixed interest rate, because the floating interest rate we assume L plus 400 basis point, LIBOR plus 400. So if the LIBOR would inch up, so would be the cost. If LIBOR would inch down, so would be the cost. So what we do, we assume that we hereby assume that the central bank did all three kind of swaps in offshore treasury center, which is Singapore, New York, London, Luxembourg, Frankfurt, Japan, Australia. These are the well established central banks across the globe. So in nutshell, you are acting as a central bank. You are having a lot of liquidity swaps in place. The purpose of the liquidity swap is very clear. Once you don't have the dollar, or in the case of huge volatility in the market, you can use the swap between you and any foreign bank, and you can utilize this money to sell dollars in your market. At the end, we should appreciate the fact that whatever you are selling, dollars and all, at the end we need to appreciate the fact that whatever you are selling, dollars or not, this selling need a hedging also. I'm not saying that you need to go to offshore treasury center for hedging, which is Singapore, New York, Australia and all. I'm not suggesting that. But at the same time, if you have the enough infrastructure in your country, like here we are talking about China, so China is having enough infrastructure in their country, then they can do in their system also. But in the countries like India, who do not have the enough infrastructure, or there are many countries, then they need to go to the offshore treasury center. And offshore treasury center, generally such kind of swaps are getting done with the helping hand of the offshore treasury centers. So this was the purpose of the liquidity swap, and we would like to link this liquidity swap in the current situation also. As you very well understand that a lot of action is happening in the market. Federal Reserve is rising rate. Next week is very important, as I already told. Bank of Japan is scheduled to give, and I'm 100% sure that Kuroda will increase the rate. I am 100% sure that the Kuroda will give an indication that more quantitative easing can possible. 100% sure. In that sense, interest rate will move to negative. It would be very easy for central banks to use such kind of mechanism, to use such kind of liquidity swap. If they do that, few countries would face the high volatility and few countries will face the less volatility. Over the period, majority of the central banks already have the liquidity swaps in place with each other, which is very good, except India. I doubt that India have such kind of liquidity swaps with variety of central banks across the globe. But China, People Bank of China and Monetary Authority of Singapore, they have a lot of liquidity swaps with majority of the central banks, which is one of the finest stuffs they did, and I would appreciate that. So with this liquidity swap turning very important, and it is also acting as a weapon for central bank to control the FX volatility. If I'm not wrong, 2008 when FX volatility was at extreme high at the top, then these liquidity swaps not only helped central banks to mitigate the volatility, but also helped to accumulate the dollar. I think India do have a liquidity swap with the International Monetary Fund, but in that with Federal Reserve, but that is limited to an amount, and Federal Reserve would like to go for a pledge, for a or a kind of deposit which you need to put up before going ahead, before taking more money. So till a money, no pledge is required, and after that a pledge has been required. So this was the purpose of today's video, is to introduce you towards central bank liquidity swaps. These are not very different than foreign exchange liquidity swaps. Hopes you like the video. And before moving ahead, we would like to remind that Treasury Consulting LLP is coming up with the chapter, with the forensic chapter. We are coming up with our website, and our website is on the way. It's not very far. We really thankful for your help on our YouTube channel, and you are most welcome to connect with us at these platforms. We are at Dailymotion, Dropbox, LinkedIn, Skype, Google Blogger, Google Groups, SlideShare, Facebook, Telegram app, WhatsApp, Snapchat, WeChat. You are welcome to connect with us on these. We are growing at an extremely fast play, very fast, and we are adding ourselves at a lot of platforms, to be very honest. And over the period you will see a lot of platforms which would be accumulated to Treasury Consulting LLP. You know our contact details, which is this. My mobile number is 9899242978, and my Skype ID is Rahul5327. My I would say my Twitter is Rahul Magan 8. We thank you very much for that, and we would like to bring to your notice that we would continue to have such kind of interactive videos for you on our YouTube channel. Thank you very much, and this side Rahul Magan, and see you soon.